Welcome back to the show. Let's talk to Connor Campbell. He's a financial analyst at Spreadex. Morning to you, Connor.
Good morning.
Right, let's have a run through of three equities. Let's kick off with Next PLC, the mnemonic NXT. Flat on the year. A little bit surprised by
Interestingly, flat on the year, but since those mid-July lows, it's up, I think, 35.5%, which is astonishing, really, given what sector it is in and how poorly it was doing, falling below £36 in mid-July. The figures haven't been particularly great either. I think it's second quarter figures in August. Total sales are down 2.2%, not good. However, their full year forecast, they revised the lower end of estimations from minus 3.5% to minus 3%. That caused a 10% jump, bizarrely. Then mid-September, again, total sales were down 2.2%. Sales of the retail sector, so basically the high street sector, were down 8.3%. Next directory were up 5.7%, sorry, but still, fairly big discrepancy there. Pre-tax profit was down 9.5%, which was the biggest fall since the recession. However, Lord Wolfson wasn't as bearish as he had been in the first half of the year. They revised again their full year sales targets to, I think now it's minus 2% to plus 1.5% instead of minus 3% to plus 0.5%. That's a fairly sizable shift for that window. As you can see, sort of 13% jump, I think, on the day of those results. People were really clamouring about for just the slightest bit of good news, and then it's rocketed back towards the £52 mark, which is where it was at the start of the year.
Just go back to the Next catalogue. Is this now online, or do they still actually deliver a physical catalogue?
It's both, I think. It is, I think, obviously shifting further towards online, and as long as Next keeps shifting towards that area, and it is having success in that area, then I think people are going to be willing not to completely write it off, because obviously it is. There have been times in the last couple of years where things have looked incredibly hairy for Next. But the fact that there has been this remarkable rise in the last, 3 or 4 months shows there is still an appetite out there for the stock. And, if you dig through some of the negative figures and look at those directory figures, 5.7% growth that's healthy.
And finally, client-wise?
Client-wise, they're buying around the £50 mark. Heading into Wednesday's third quarter results, it really then needs to prove that those full year sales target shift has been proven to be correct. It needs to show, ideally, some kind of positive total sales growth. If not, at least a lesser version of the negative growth that it's been seen. But if you look at the retail sales figures from September and then the CBI ones from October in the UK, they're pretty bad. So it'll be interesting to see whether Next can sort of shirk the sector's wider issues and post some decent growth on Wednesday.
Understood. Let's move on to Morrisons. The mnemonic MRW down just a smidge on the year. Interesting headline this morning. Morrisons leads way up as milk goes up 10%. A little bit of inflation there. That's a pretty ropey chart, isn't it?
Oh yeah, this year it's been all over the place. It's just been trading between 230 and 250,
and a lot of shorts in there from the hedges.
Yeah, I think it's spiked towards 254, which was like I think 3.5 year high. But yeah, just really not finding its sort of momentum either way. Interestingly, you can see in September that the last sort of leg lower it's taken and sent it towards sort of its current 227 figures. Now that was the date of its half-year figures, and they were really good. Like-for-like sales were up 3%, turnover was up 4.8%, underlying pre-tax profit was up 12.7% to 177 million. It hiked its interim dividend by 5%. Really strong figures, but just investors didn't buy it and it sent it lower. In terms of its figures this week, third quarter figures on Thursday, I think analysts are looking for like-for-like growth of around 2% plus. That would be the fourth consecutive quarter of like-for-like growth, sort of continuing the really robust turnaround Morrisons has seen under David Potts since he took over in March 2015. Our clients are buying around that 227 mark. I think there is room for it to bounce back because its figures, consistently recently have been very strong. I think investors were perhaps a bit too harsh on it in September, and there is room for it to bounce back, and I think that's why our clients have been buying at these lows.
Understood. Okay, let's wrap up with Apple. Mnemonic AAPL up 43% this year. What's the story?
Interesting, up 43% this year, but as you can see from the chart, since around April, May, it hasn't been smooth sailing. It has consistently hit new highs, but as you can, there have been a few moments of doubt surrounding the stock. Its third quarter figures back in August, they sort of bear out why it has done so well. I think adjusted earnings came in at $1.67 against $1.57 expected. I think revenue was around $500 million higher than expected, 45.4 billion. iPhone sales were at 41 billion, which, for what people thought was going to be a lame duck quarter just before the iPhone 8 come out, is very healthy figures. However, since then there has been consistent questions about demand for the iPhone 8 and whether that's as high as it has been for the previous iterations of the device, and questions over whether are people not buying the iPhone 8 because they're waiting for the iPhone 10, which I think is, pre-orders went on sale last Friday, and then at the same time issues around production of the iPhone 10. I think production's meant to be maybe around the 2 million mark or something like that, which is, far lower than what Apple would normally be shipping for a new phone. Obviously, on the flip side of that, that does create a sort of an insatiable demand for that product, and it's almost guaranteed to sell out. And I think there has been so much doubt around the iPhone 8 that it might not be that hard for Apple to beat expectations, really. In terms of revenue, Apple itself stated that it's expecting fourth quarter revenue to come in between 49 million and 52 million. I think the midpoint of that would be an 8% increase year on year, which for a company Apple's point in its history is very healthy. I think analysts are expecting it to be to the lower end of that, around the 49 million mark, but again, that leaves plenty of room for it to beat. Earnings per share around, I think, $1.87. Also, as a sideshow to the sort of the iPhone focus, they recently hired Jay Hunt, who was the woman that brought Bake Off to Channel 4 as the head of their chief head of their European operations in terms of original content. So they do, I think they've also poached a couple of people from Sony. They do seem very serious about entering the original content market, and I think investors will do good to look for sort of signs of that there. How serious are they about taking on Netflix and Amazon and the like, basically. From a client's perspective, really heavily buying around, the $160 mark and above. It's Apple. I think the figures recently have been pretty strong, and they're buying going into their fourth quarter results on Thursday.
Connor, thank you very much indeed.